Oh, so we are starting now. So, good evening, everyone. Today we are going to be looking at, in continuation of our normal class, we're going to look at how to find our confirm you can hear me so that we can go on. Hello? Can anybody hear me on the call? Confirm you can hear me so that we can go on.
We can hear you.
Okay. So let's go to etas.lrs.net. So we click on the first. Okay. So we click on the first drop down that comes like this. Exactly what I was trying to prevent. The server is slow. Okay, so while this is trying to open, we might need to do other things because we won't want to sleep here. So let's quickly go and look at how to do. So we're going to do something today. I will show us how to do fixed asset, our fixed asset register. We're going to look at something together. Let's go to downloads. For my downloads, there is a file I want to work on. So let me come to my downloads. Right. So this is the download. Let's come to, yeah. So let's come to this file that we have over here. And let's open this file. Okay. So this is like a fix. So this is like Zoho Books template for fixed asset. Okay. Under this template, you're going to see, yeah, somebody's hand is up. I can hear you. Go on. Okay, you have stopped sharing. Oh, sorry. Okay, so now I'm back now. So now you can see my screen. I'm still trying to like open the ETAS portal, but I will not wait for this forever. So I want to go on to do other things while we are waiting for that. So let me quickly go to the file we are going to work with today. We are going to work on our fixed asset register. And I know why I'm trying to show it to us, because if we don't know it, it's going to really affect us in whatever we are doing. So let me see. Okay, it's not here. Oh, yeah. Okay, so this one now is our fixed asset schedule. So normally, most times accounts should have accounting policy. Okay, so one of the things that is really important for us to show how we arrive at them is depreciation. Depreciation is the systematic allocation of depreciable amount on the cost of an asset. So the process of allocating the depreciable amount of an asset on that asset, on the cost of that asset, is what we call depreciation. So is the systematic allocation of depreciable amount of an asset on the cost of the asset. So here we have the policy of this company. So for this company now, they decided that for the depreciation for their furniture and fittings, they will usually charge 10%. Okay. So to know how many years each of these things will last, what you do is that you now say 100 divided by 10 to make you know how many years it's going to be. So for the furniture and fittings, we now say, okay, we say like 100% divided by 10%, sorry, divided by 10. Then we know that the first one is going to be, all the furniture and fittings are going to be for 10 years. Then for motor vehicle, it's going to be 100 divided by 100 divided by 20, which is going to be 5 years. Okay, so the motor vehicle is going to be for 5 years, and other assets are going to be for, some are 10 years, or yeah, majority of them are 10 years. I think the only one that is 5 years is yeah, is only the motor vehicle account that is 5 years. Okay, so and that is 20%. So that is the policy of the company. Then the next thing you want to do is that you want to now see uh, fixed asset register by year, right? I want to see fixed asset register by year. So here we are showing all the serial number, the date is important, the class of asset, the description of the asset, the supplier's name. All these things are very important. Then the reference number, the index number, the amount that you purchase the asset, then the location of the asset is important. Then the cost of the asset. Then we now start our depreciation. So this is the depreciation rate based on the policy of the organization. So this is the depreciation rate. So here we are looking at fixed asset register by year, looking at the year in which we purchased it. So that is the years that we purchased it. So let me try and see something that you need to take note of in case of incasity. Yeah, so this is 2010. This is 2010. Yeah, so 2010. Then let's see this one. This is 2011. So we are showing it by the years that they purchased them. So this is like 2012, and this is 2013, and so on and so forth. So you can see here 2014. Then here is 2015. So then let's come to this one by class. Okay. So then what is the difference between what we have over there and what we have over here? We're also going to look at it together. So here we have by class, cost of the asset, class of the asset, and here, okay, the same class of the asset. So I guess there's no major difference between these and the other one. So you need to have this information. We are having the class of the asset, the date we purchase the asset is very important because we need to do yearly depreciation for each of the assets. Now, the reason why I'm teaching you this is currently I am having a training for a company, and that company, they they have issues with how to treat fixed assets on their accounting software. So they're actually making use of Zoho books. So another issue they had was they also look at how to treat inventory, okay, in their Zoho books. And I've been able to teach them is an oil and gas company. I've been able to teach them inventory. So the next lecture we're going to be having for Monday is going to be on fixed assets and all that. So it's going to be on fixed assets and also on payroll. Okay. So let me quickly check what I'm checking. Okay, this is not working yet. Okay. So we now come back to this place. We already have the class of the asset, the description, the supplier's name, the reference number, the index, the amount, the location. So under this amount, let me check to the bottom. So there is nothing under the amount. Fine. Nothing is under the amount. Okay, but we have the location and the how many numbers. How many is it? So here, that is under index. You're going to have how many is it? Is it one? Is it two? Is it three? And so on and so forth. Then the location is important. Then here is where we have the costs. So the cost is what we have over here. Now, we also know that this asset is the first one is furnitures and fittings. So that is the class of the asset. Then the description is what we have here. So because it's furnitures and fittings, the rate of the depreciation is actually 10%. So how do we now start doing it? Now we are going to look at what year. So this is any asset that was purchased in 2010 is going to fall under here. So what you need to do is come over here. All these assets that were purchased in 2010, this was purchased in 2010. The other one, all these ones they were purchased in 2010. So that means that the first year that you're going to work on is for 2010. So we come over here. We now say, okay, this asset was purchased in June, on 1st of June. That is going to be like from June to December. It's going to be June, July, August, September, October, November, December. That's supposed to be 7 months. So that is why they are having 7 over here. So what do? The first thing is that you know that it's 10% that we are charging. And this asset is supposed to be for 10 years. What do? You now take 10% of this amount, which is supposed to be the normal yearly depreciation. But because this thing is just for 7 months, you now say equal to this times this. Okay, you now say 7 over 12. Okay, or divided by 12 times 7 is the same thing. So this times this, right? Whatever answer you get times 7 over 12, you're still going to get what you answered. So this is for 7 months. Okay, and that is how we are able to do all of them like that. So the first month, the first year, which is 2010, this asset is going to be only 7 months you're going to deduct. Then the next year is going to be the full amount. We're going to continue like that until the 10th year. So the first year we only deducted this, then until you go to the 10th year before you are able to like stop, and then that's when the asset is going to go off. So when we count, we come over here, we count from here, we say 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So yeah, so the 10th year is going to be, if you add it to the first year, I think it should give you a full amount. So we count 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Okay. Yeah. All right. Yeah. So in the last year, look at what happened in the last year now, because this stuff is supposed to be for 10 years. In the last year, we just pick every other thing that is remaining. We just took it over here. So you discover that in the last year, the whatever we did not charge in the first year, that's 6 months that we did not consider in the first year. We now came and added to the last thing that we have in the last year. So that's how we're able to get our depreciation. So from there, you're going to be getting your accumulated depreciation, accum So by summing everything together to give you what the accum is going to be. So you're going to do the same procedure for all the assets that you purchased in 2010. So that means that is that for all the assets that you have in 2010. So we are arranging it based on year, okay? Based on year. So this is 2010, right? Once we are done with the asset that was purchased for 2010, we now go to 2011. So when you come over here, only 3 assets were purchased in 2011. So you now come over here and you come and check them. So these are the cost of the assets. And then the asset, what kind of asset is it? If it's not motor vehicle, it's only motor vehicle that is different. All other the rate of the depreciation, only motor vehicle that has 20%. Others have 10%, 10%, 10%. So we will be looking out for, if you don't see motor vehicle here, we know that everything is going to be 10%. So we now come over here and we're going to say, okay, the cost price of the asset is this, and then the rate is going to be 10%. So this asset, was it purchased in 2010? No. That is why in 2010 we have 0. But in 2011, what month did you buy it? We actually purchased it in June. In June 2011. So that is going to be like 6 months. So you are going to do the same thing that we did before. The same thing that we did before is what we're going to do. We come over here. We now say equal to, from June to December is 7 months. We now say equal to this 10% times 2,500. We are going to get a figure. We now say divided by 12 times 7. Or when you say this 2005 times 10%. Whatever answer you get, you now say times 7 over 12 to get the portion that you are going to get for the first year. And don't forget that this is 10%. It means that this depreciation is supposed to go for only 10 years. So the first year, we did not get the complete amount. We don't get the complete value, right? So, but we are still going for another 10, another 9 years. So this is the first year, the second year, the third year, fourth, fifth, sixth, seventh, eighth, ninth, and then this is the last year, which is the 10th year. Okay, so that means that there was actually a mistake in the first one. So this is the last year, which is the 10th year. Then the other difference now came over to the other side. That means that here there was actually a mistake. There was a mistake in the first thing they did over there. They also show it separately on the account. No problem. So that is that. So the same thing you did is what you're going to do for the other asset that you have over there. Yeah, this one was purchased in March. So you count January, February. You want to go March, April, May, June, July, August, September, October, November, December. So that is going to be like 10 years. So 10 months, sorry. That's going to be like 10 months. So over here now, you now say, why is it 9? Let's see, from March to, hold on. So this is from March, 1st of March. Yeah, so that's 1st of March. So we now say like here, January, February. So we now say March, April, May, June, July, August, September, October, November, December. It's supposed to be 10 months, but I think there was a mistake there, but this is supposed to be 10 months. And that is what it is. All right, so it's supposed to be 12 times 10 in order for us to get 10 months. Am I right? Everybody on the call, am I right? Accountant on the call, when an asset is purchased in March, how many months is that?
Can I try that?
Yes.
Depending on the day in the month of March, if it's from first, if it's on the first, then we'll say it's 10. If it's
Okay.
from on 31st, we'll say I think 9.
Okay. So yeah, let's check it. So this is it now. This is from the 1st of March, right? So that is supposed to be, so if it's on the 31st, it's supposed to be 9. But since it's on the 1st, it's supposed to be 10. Okay. So I'm just like trying to show us what is happening here so that we understand. So all these things, they are not cast on stone. They are things that we can, okay. So there are things that we can actually also look at and get them. So now just, so that is that. So in the first month, they only charge 9 months, which is supposed to be 10 months, but no problem. So depending on, they understand why they're charging that. But me, I'm just trying to show us what is done. So you discover that at the end of the day, for each year, we are having addition of all the assets, the cost of the asset that we have for 2011. We have it over here, this plus this plus this. We're having it at 65,400. Then over here, all the depreciation that we also did over here, they are going to be like, for 2011, this is the accum for 20, the total, right? So this is the total over here and so on and so forth. And that is how they did it till the end. So over here now, we're going to have accumulated depreciation. Okay, we're going to have accumulated depreciation over here. Right. So yeah, so all these assets, they were finally utilized. Net value was 0 at the end of the day. And that is how we're going to do for every other thing. Let's just check. This is the office building now. Office building, everything is going to be 10%. So this was purchased in 2012. So discover that we are showing it based on year by year. So the first year that we have is 2010. The second year that we have is, so let me now go to how we need to make use of that information. So all this information that we have. So when you come to this kind of information that you have here, right here, you're going to see the fixed asset name, right? You're also going to see, you're also going to see the current quantity, the current value, the disposal value, and so on, the type, furnitures and fittings. So you need to know what is the policy of this company. So just give me 2 minutes. 2 minutes, please. 2 minutes. 2 minutes, please. Yeah. Okay. Sorry for about that. I just have to pick the call. It's very important. Yeah. So we now come over here. So this is office equipment. So what I'm saying is that this is not all. After we are done with classifying it per year, by class, we now go and so we've been able to see that the first set of assets were purchased in 2010, then the next one were purchased in 2011, the next one was purchased in 2012, which we are working on. But let's quickly check what they did over here. So this one was purchased in August, and so we assume that it was purchased on the 1st of August. So we now come over here. So August, September, October, November, December. That should be like 5 months. So we come over here. We know the policy of the organization. The policy of the organization is actually 10% for all assets except for motor vehicle, that is 20%. So when I say, okay, 10% times this amount. So it's not, there's nothing going to be charged in 2010 because the asset was not available by that time. Nothing's going to be charged in 2011, but it will start charging in 2012. So when I say, okay, 5/12, that is what it did over here. Then this asset is going to be available for another 10 years, right? So it's going to be available for another 10 years. Now, because here, the as at the date we are trying to get the accumulated depreciation, that date was 2021. Okay, so that date was 2021. So as at that date, the stuff has a net book value. So all these things are what you need to take into consideration. So if you want to use something like this, right? You want to use something like this, and then you want to like create a fixed asset register for the company. You need to learn everything that was done here so that you can also just change it and all that. So that is that. At the end of the day, we can come down and check if there's another thing. Okay, so here is where we have the motor vehicle at 20%. So we need to check for when this one was purchased. It was purchased in February, on 1st of February, and all that. And then there was a disposal or by December 2014. So let's check what is happening over here. So a motor vehicle was disposed. So as at the time it was purchased there, we are looking at 20% for all this. But why are we, oh, did I make a mistake? Yeah, okay. So all these are the assets in 2014. Sorry. All these assets were purchased in 2014. It means in 2013, no asset was purchased. But in 2014, all these assets were purchased, right? So all the assets that were purchased, motor vehicle, furnitures and fittings were purchased as well. The motor vehicle was disposed over here. So we now come over and check over here. For the motor vehicle that was purchased is 20% depreciation rate. This is the cost, then this is the rate. So then what location is that motor vehicle? The location is in Lagos. Then these, I think another one was also, yeah. So I think this is the one that was disposed. This one is in Lagos. The other one has been disposed. And that is what they brought down to the bottom to show the details of the disposal, okay? So let's now move on. So we now come over here. I will do it because it's in 2014. then counting it based on the numbers of years. So the first year is going to be prorated, other years won't be prorated. And that is how we're able to do that like that, like that. So year by year, we are actually treating each of the items that we got, okay? Each of the items that we got per year. So that could be why, so that could be why they say fixed assets register by year. So do we have any question? Can we move on? Any question at all? Okay, so you can see that the last year was, the last depreciation they did was 2021. And that is why the accumulated depreciation shown is also shown as per 2021. So if you come over here, you discover that the accumulated depreciation, so accumulated depreciation is as 2021. So, and yeah, so and then the net book value also at that date is also showing over here. So I just needed to show us this so that we understand what is going on. Then we can also go and check the position by we can also go and check the position by what's it called? Yeah, by class. So let's come over here and quickly check what we have over here. So we still have those assets. Now here, you discover that here, all the assets are now showing by class. Now, the difference between this one and this one is that here, we are treating it based on the years. Any asset that we buy in 2010, we list all the asset that was purchased in 2010. So we are looking at it by year. But in this one, by class, we are actually checking where are all our furnitures and fittings. We are listing all our furnitures and fittings irrespective of the year they were purchased. Are we together? Do we understand the difference? Can you unmute? So the other one, we're only showing all the list of assets that were purchased in 2010. And I think this actually makes depreciation easy to achieve. But the other one, we are actually showing irrespective of when this was purchased, we want to show all the list of functions and fittings that we have. We want to also show all the list of motor vehicles that we have, irrespective of the year that they purchased them. We also want to show all the list of furniture or office equipment that we have, okay, irrespective of the years that they were purchased. We just show all of them as a list and so on and so forth. So with this classification, we now discover that all our assets are classified into just office equipment, as well as motor vehicle, as well as furnitures and fittings, as well as office building. So that is how we classified it. So you should know the difference between the two. Is anybody following? Do you understand the difference between the two? Are we together?
Yes, sir.
All right. So that's just that's the major
Now, please, can
difference.
I ask, is it that one is better than the other, or you can just do it anyhow?
Yeah. So for ease of your picking, you can do it. So it depends on what you want to achieve, actually. For instance, if you are doing it by year, you can at a glance ask yourself that, okay, what is the, so it's easier when you do it by year because accounts are done year by year by year by year, okay? So you can easily just go and check what is the depreciation for 2010. It's easy for you to quickly go and check it and you get it straight for all the asset. But if you want to now, we will come to this place later, okay? We are going to come to it. I will explain it with this one because here we are now checking it by the class. We're going to check it by the class. So here, I'm just telling you that it's for ease of knowing the years that the assets were purchased and what is their net book value and all those stuff, you can actually use that or this method. So I will advise that we should keep by year as well. We should also keep by class. It's actually very, very important. So you can see what this one is now. This is by class actually, irrespective of when it was purchased. So it means that we are going to have different sections for different type of asset. The first section over here is our office building. Then the next one is our functions and fittings. So any functions and fittings that come, we add the first one. We continue to add, we continue to add, we continue to add. Then the one that is here, we now also have motor vehicle. We continue to keep our motor vehicle. Then our office equipment, we continue to keep them as well. And then it makes it easy to also say, okay, how much office equipment do we have? We can quickly check how much depreciation was charged to our office equipment in 2010. We can quickly check what is our net book value for all the office equipment that we have. We can also get it. So whichever you do, both of them are good. So we advise us that keep them by year, also keep them by class. Both of them are important. So when we now come to this place, this is where the actual work is being done. Now, because we already know, based on the depreciation per year, we know that the first set of assets that we purchased were purchased in 2010. So it made us to be able to know that, okay, the first year that we need to do our depreciation for is year 2010. So we come to year 2010. We now say, okay, for our year 2010, what classes of asset do we have? So we know that this is property, plant, and equipment, Abby. So we now know that the property, plant, and equipment we have motor vehicle, we have office equipment, we have functions and fittings, we have office equipment, we have computer equipment. So here in 2010, we didn't have anything like building. We didn't have anything like building. It was later on that we now went to have building, which we have over here. And that building was actually purchased in 2021. But prior to that time, there was nothing like office building. Okay, so that was that. So we now come over here to this is actually where the work is being done. We now come here now. We now say, okay, how much motor vehicle? Because here now, you're now doing in sum. Our costs, here are the costs, right? So the details, motor vehicles or property, plant, and equipment are always kept at costs, as well as you also show your depreciation, accumulated depreciation, your depreciation for the year, your balance as at that date, then what is going to be your current amount and all that. So we now come over here, we now say, okay, this is our asset, motor vehicle, functions and fittings, office equipment, computer equipment. Then we have our total. So our cost is here. Let me make it bold. These are our costs. And then these are the Naira sign, right? Control B as well. So we now say, okay, what is our opening balance as at the 1st of January 2010? We don't have any opening balance. It's very important because this is a new company. We don't have any opening balance. Then the next thing we now say, okay, addition for the year. So you can see that here we are actually picking by year. Okay, addition for the year. Let's come back to this place. We discovered that undermining the fact that okay, by year. Yeah, undermining the fact that we listed all the assets together, right? Undermining the fact that we listed all the assets together. Let me go and check what they picked. So we now come over here. Let's check this thing that they picked because this will be the cost. So let's go and check what they picked. This is motor vehicle. I'll just press control open bracket and it showed me that okay, this is what they picked. They only picked what related to let me see, they only pick what related to motor vehicle. Yes. So because we are looking at here, so you see that what they are picking from is this. So it's better you have it per year. Okay, have it per year and also have it per class. You can keep both of them. It's the same thing, but just so that this one, because they listed them based on the years that they bought them, this is going to be easier for you to do. So the first thing we have here is to pick the cost of the asset. You start by saying opening balance as at the 1st of January 2010, there was no opening balance. We are just starting the company. They don't have any asset. Then what is the addition during the year? Addition during the year, you're going to pick the motor vehicle, the total. It means that if you add more than one motor vehicle, probably you have different motor vehicles and all that, okay? You are also going to go and add all those motor vehicles together. You're going to go and add all those motor vehicles together, okay? And that is what you are going to bring under this addition. Then the next thing for functions and fittings, they also picked it. So let's go and check what they picked. So for functions and picking, they actually they summed things. So let's go and check what they picked. Okay, so look at what they summed. They summed all these things, and let's now come to the front to see what they are summing. They are summing all the furnitures and fittings because they are here. They summed all of them together, and that is what they put over here as the addition. So office equipment is the same thing. Then computer equipment is the same thing. So you can see that all these things were taken from um, fixed asset register by year because we're going to be doing our detection by year. So that is where we are picking it from. We're picking it from there by year. At the end of the day, we are going to now have the total of all the asset that it was purchased in 2010. It's going to be over here. Then closing balance as at 31st December 2010. What is our closing balance? Our closing balance is we're going to have a closing balance like this. The closing balance is going to be the addition of if there were to be opening balance, okay, and then if there were to be addition for the year, they're going to add everything together and it's going to be over here. So that's how they got their closing balance for cost. Then over here, closing balance for cost over here, going to be addition of opening balance plus closing balance and plus addition for the year. Sorry, that's how they did that like that. Then the next thing is that you have gotten the cost. The next thing, let's now work on our depreciation. For our depreciation, we know that opening balance for depreciation is going to be nothing. There's nothing in our opening balance, right? Then our charge for the year. Don't forget that your opening balance is going to be like your accumulated depreciation, you know, as at the beginning of the year. And then because there was no asset at the beginning of the year, there is nothing. And then it also means that there's no accumulated depreciation. The first thing we did was to charge the what needed to be charged for the year. So here, when I say charge for the year, we are going to have the depreciation that we computed. So let's now go and check. Yeah, and that thing that you are going to do is that because we know that this is motor vehicle, right? A motor vehicle is always depreciated 20%. Motor vehicle is going to be depreciated 20%. So it's raining over here in case you are hearing some noise, it's rain. So motor vehicle is going to be depreciated per 20%. So when I come over here, when I say, okay, equal to 20% times the total, the closing balance. Now the closing balance is going to comprise of your opening balance plus your addition for the year. So they are not only, the mistake that people do most of the time is that they will now come and do their depreciation charge for the year. They will do it only the addition for the year. Okay, I hope there is no question. Okay, so that's what most people will do. The mistake people do is that they come and do their depreciation for the year. They come and charge it on only the addition for the year. No, your depreciation for the year should be done based on the total. So let me just press something, control. Yeah, so look at it. They are charging the depreciation, which is going to be 20% times the closing balance for the cost of that asset for the motor vehicle. They also do the same. For this ones now, they are 10%. They are all 10%. They are all 10%. So let me now tell us something, right? So at the end of the day, what you're going to put in your financial statement, right? You know, we have statement of profit and loss. What you're going to charge as depreciation for the year is this total. You're going to charge this total into your financial statement. So what you're going to do is that you're going to debit. So let's do something. You're going to debit. You debit. Sorry, you debit. So here is going to be debit, and here is going to be credit. Here is going to be credit. Okay. So what you're going to do is that you now come over here. You now say your depreciation account depreciation depreciation account is going to be debited by this value, the charge for the year. The charge for the year is what you're going to put in your depreciation account. Then, to now make this in balance, to balance the leg, you're going to now say, okay, acum div dash, sorry, acum div dash motor vehicle. Acum div dash motor vehicle is going to come over here. You now say like equal to, you now say, yeah, depreciation for the year, charge for the year for motor vehicle, you're going to pick this one, right? You also say acum div dash dash, what's the next thing? It's going to be F and F, F and F, right? So you're going to have it like equal to this value, right? The charge for the year is what you're going to pick. Then you also say, now, because what we are picking in our depreciation that we are posting to our profit and loss account is actually this chart for the year, the total of the chart for the year, right? So because of that, we shall only take note of this. So also, to balance this thing, if this is debited, obviously all these things are going to be credited. They are going to be credited to the accumulated depreciation account. So we've done for furniture and fittings, office equipment, and computer equipment. So we now come over here, we now say accum div for office equipment, office equipment. So accum div for office equipment is going to become equal to this. So what is the depreciation for the year that we are actually treating. Okay, depreciation for the year is what we are treating. So, and this thing is what we're going to go and post in our software. Okay, then the last one will now say accum div for computer equipment. So this is what we're going to post for our company for computer equipment. We're going to equal to, we now come over here and select this, and this is what we're going to put there. So you go to your software, you're going to use journal to pass this thing. You're going to journalize it and pass it so into your software. So when we get to the point when we start using our software, I'll show us how to actually go about this. So the first thing now, we've gotten how to treat this. First of all, have your opening balance, have your addition for the year, add your opening balance to your addition for the year to get the closing balance as at 31st December that same year, 2010, sorry. Therefore, your depreciation, you are going to have your opening balance as well. You're going to have what was charged for the year. Your charge for the year, because we already know that for motor vehicle, based on our policy, it is 20%. So now say 20% times the total. Now, it's not 20% times the addition for the year. Don't do that mistake. It's 20% times the total. So the total of both your opening balance plus your addition for the year, you now take 20% to get the charge for the year. It means that if this thing still has an opening balance, it still has an opening balance, it means that asset is still available. Is still available, and the depreciation is still going to be charged on it. So that's how we are getting the depreciation on it. So we are going to do depreciation on everything. At the end of the day, we also now do our closing balance, which is going to be our opening balance for our depreciation plus our charge for the year. We're going to have the closing balance as at the last day. Then another thing we're going to do is I want to now get what's the current amount of our asset as at the beginning of the year. Obviously, our current amount is going to become our, let's check what they did. Okay, so our current amount is going to be our cost, usually our cost minus our accumulated depreciation. Our cost at the beginning minus our accumulated depreciation at the beginning. We are going to get what the current amount of the asset should be as at the beginning. As well, we also want to do the same for at the end of the year. We now say our total at the end over year, right? minus our total at the end of a year in order for us to get what the difference is. So that is where we get our accumulated. So we're going to be getting our carrying amount as at the beginning of the year. We're also going to get our carrying amount as at the end of the year. Any question? Does anybody need any clarification? I've shown you what you need to do based on the chart for the year. I've also shown you what you need to post to your accounting software. Pick the total amount, post it to your depreciation account in your profit and loss account. Then what make up this total is what you're going to post to in the individual accumulated depreciation accounts that you're going to have. So then you now use journal to post this into the software. Okay, open a journal, you debit depreciation expense account and credit all the accumulated depreciation account. Okay, is there any question? Can we move on? Any question? Can we move on? Okay, Mr. Ibrahim. Do you have a question?
No, no question. I just joined. Good evening, sir.
Oh, okay. No problem. All right. So that is fine. Yeah. So that's been done. Then we now come over and check. So now the beauty of this thing should not stop at just the first year. The first year is actually easy. In the first year, no opening balance. Everything is good. We just have addition for the year, which we have. Then we also have our closing balance, which is supposed to be our opening balance plus the addition for the year, which will give us our closing balance. So for our depreciation also, our opening balance, then our charge for the year. Our charge for the year is always gotten based on the closing balance for cost, not just the charge for the year. Let's take note of that. So it's going to be based on the cost. Then what we now do is that the next year now, in 2011, we now discover that what you're going to pick as your opening, the same template is what you're going to use, the same template. But what you're going to pick as your opening balance for your cost is going to be the closing balance for this place. You know, yeah, this was our closing balance. Our closing balance was actually the addition of the opening balance at the beginning plus the charge, plus what they purchased during the year. That's what gives us the closing balance. So this automatically becomes the opening balance in 2011. If you check it, this is what they picked. So let's go and check. What did they pick? They actually picked it. You can see. So that's where you pick your opening balance. Your opening balance for each of those things. Pick your opening balance. Then the next question you ask yourself is that, is there any addition for the year? For this addition, let's go back to this place. And if you come over here, we now come to, you know, we are done with 2010, right? We now come to 2011, right? Under 2011, we only have office equipment that was purchased. We also have furniture and pieces. So it's only those two assets that was purchased. So we now come over what? Oh, sorry. Yeah. So we now come over here. So this is it. We now come over here. What is their cost? Is their cost that we are particular about? What is their cost? This is the cost for the furniture and fittings. Then for the office equipment, this is the cost for the office equipment. These two are the cost for the equipment. So we are going to add both of them. So in 2011, so addition for the year, no motor vehicle was purchased, no computer equipment was purchased, but furniture and fittings was purchased. This also was purchased. At the end of the day, we now say, okay, what should be our closing balance for our asset at cost? It's going to be this plus this, which should give us this, right? This plus this, which will give us this. This plus this, which will give us this. This plus this, which will give us this. Then at the end of the day, we also have all the balances over here. That is fine. Then the next thing, let's come to the depreciation section. Remember, your depreciation section is your opening balance is going to be your closing balance for the last period. So your closing balance over here was actually this value. So we want to pick this closing balance for your depreciation. Your depreciation closing balance is the combination of your opening balance of depreciation plus the charge for the year. That's what gave us the closing balance. So this automatically becomes the opening balance in this place. So when I say, okay, opening balance is going to be this, let's go and check what they pick. They pick this, okay? let's go back again. So let's go back again. Let's go back again. So the same thing happened here. That's what they picked, right? So the same thing happened, and that's how we are getting our opening balance. Now, the next thing we're going to do is that the charge for the year. Remember what I told us? Charge for the year is always going to be the what's it called? The we know that motor vehicle is 20%. We are going to take 20% of our closing balance irrespective of anything. Take 20% of our closing balance. And then we also know that some assets, since it's motor vehicle, some assets are always going to be for, like, let's say 5 years, right? So we now come over here, we now say, okay, 20% of our uh 20% of our closing balance is what we're going to pick over here for our charge for the year. 20%. So here are 10% of our closing balance, 10% of our closing balance, 10% of our closing balance. At the end of the day, we add everything together. This becomes the charge for the year, which is what you are going to debit to your depreciation account and now credit the individual accumulated depreciation account. Then at the end of the day, you also now come here and do your closing balance. Your closing balance now is going to be your opening balance plus your charge for the year is going to give you this. Opening balance plus charge for the year gives you this. Opening balance plus charge for the year gives you this. Opening balance plus charge for the year gives you this, and so on and so forth. Then, we usually get the carrying amount as at the beginning. So the carrying amount at the beginning is going to be your opening balance minus your opening balance for depreciation as well. Opening balance for asset cost minus opening balance of depreciation cost. That is what they did over here. At the same time, you also want to get your carrying amount as at the end of that year, which is going to be your closing balance for costs minus the closing balance for this as well. That gave us what we have over here. Are we together? Are we together? Is it making sense? Are we together? Okay, let's now go to 2012. The same approach is what we applied in 2012. In 2012, you're going to have opening balance, right? You're going to pick all the opening balance, which is going to be closing balance for last year. All the closing balance for cost last year is what they're going to pick as opening balance in 2012, right? What they're going to pick as opening balance in 2012. Then, apart from that, we now say, okay, what is the addition for the year? Addition for the year is going to be gotten based on our fixed asset register by year. We now come to 2012 now. 2012, we are looking at this. So this is 2012. The only asset that we purchased in 2012, let me check first. Let me check. The only asset that we purchased in 2012 is let me see. Yeah, we purchased office equipment. We also purchased furniture and fittings. So just two assets is what we purchased. So we now come over here in 2012. We now say, okay, addition for the year is only going to be furniture and fittings and office equipment. So when we have that, we now say, let's get our closing balance. Our closing balance is going to be this plus this. We're going to get this. Like that, we had everything together. We got all this. Then when we now come here, we now say, okay, in that case, what is our depreciation? Opening balance. Pick the opening balance from the closing balance for last year. Then what is the charge for the year? The charge for the year is going to be 20% of the closing balance for costs. 20% times the closing balance for cost. So if you check it, you do something like this. Yeah, 20% times the closing balance for cost. Right? Right? Are we still together? So yeah, so are we still together? Can you hear me? A call came and I needed to answer the call quickly. Otherwise, it will disrupt the class. So Yeah, so that is how we're able to do this, right? So we now say, okay, these are the closing balances. These are the closing balances. Then is our chart for the year is going to be based on the closing balance that we have for all these plays. So once we have gotten the chart for the year, the next thing we want to do is that we now say, okay, the opening balance that we got plus our chart for the year, we're going to get this. Now, it's important for you to note that what you will continue to pick at any point in time is always going to be the charge for the year is what is important to you. So what is important to you? Pick up the total that is the charge for the year. When you pick up the total that is the charge for the year, you debit it to your profit and loss account. Then the individual thing component that makes up this total is what we are going to post to the credit side of individual accumulated depreciation, sorry, accum div account of this fixed asset. Okay, that's what you're going to post. So that at the end of the day, you use journal. Okay, it's journal that you're going to use actually to pass them. It's journal you're going to use to actually capture them into the account. So let me tell us something. One thing is very, very important. And what is that? Now, there's something I did not mention. I was telling you how to actually capture those assets in your account. However, as at the time you were purchasing these assets, there were expenses that were incurred. When you're purchasing this asset, okay, as at those dates you're purchasing the asset, what you do is that you debit the asset account. You already have a chart of accounts in your software. So that chart of account, okay, you already have all the assets that you have, right? So as the transactions are happening, apart from you recording them here, you are also posting them to your account, to your software. So the first transaction that happened here was on June 1st, sorry, June 1st, 2010. So that day, you have debited functions and fittings in your software, and then you now credit your bank or however you got the asset, either you are owing a vendor, okay? If you're owing a vendor, you debit your functions and fittings account, you credit a receivable to show that you are actually owing that customer. So at the end of the day, so let's come and check. In 2010 now, apart from you passing this journal, this stuff is not complete without you showing that you already have an asset, because it's the asset that you have already that you want to pass this. You want to now show that the depreciation aspect is going to your profit and loss account. Then the account div is to be shown against the cost, so that at the end of the day you say, okay, how much motor vehicle have we depreciated? Okay, we have depreciated only 451. Okay, so you continue to accumulate. So you want to, apart from doing this, you're also going to do something. So you now come over here, our assets, as at the beginning, because you're going to start from the very beginning. From the very beginning, the first year, you're not going to have any opening balance, but you're going to have additions for the year that you purchase that year. So what do? Here, this you go. You what? You now debit motor vehicle account. So apart from you posting this one, you're also going to have, like, the first thing you ought to have done is this. Let me copy this like this. I'll copy this like this. I'll put it here. The first thing you ought to have done is that you ought to have say, okay, you are going to have how many assets? That is 4 assets, right? Let me add more additional, or let me just move this one downwards. I just move this one downwards. Yeah. Okay, I'll just move it downward like this. Yeah, fine. So what you're going to do is you say, okay, the first asset that we have is actually motor vehicle. So we now say motor vehicle, motor vehicle. So this motor vehicle, as you are purchasing them, you are already posting in your software. You don't need journals to pass all these ones. So for the asset, the asset itself, you don't need journal to pass them. So just, okay, this is motor vehicle. How much is the motor vehicle? Motor vehicle, you debit it equal to, you pick this one, debit your motor vehicle account by this, right? Then you now credit bank. So let's do something. Let's have all of them. We have functions and fittings. So let me copy this. Okay, functions and fittings. I come over here also. I say furniture and fittings. So your functions and fittings, you come here, you say equal to, you also pick this one. You pick this. Then the next one, you also have office equipment. That's office equipment. So your office equipment, you now come, you say equal to, you're going to pick this, right? Sorry, you're going to pick this, and it's as at the beginning. There's no opening balance. Then the last one, you have computer equipment. You now say computer, computer equipment. So your computer equipment, you're going to say equal to, then you're going to pick this, right? Computer equipment, you're going to pick this, okay? So with this, the leg is not balanced. So the leg is not balanced. So to balance the leg, we now credit our our bank, our bank or our account payable. So we credit our bank or account payable. So equal to, sorry, it's going to be equal to sum. We open our bracket. We are adding all these things together. We're adding all these things together. We close the bracket and we say enter. So this is what we are going to post. So as the transactions are crystallizing, as the transactions are happening, you are already posting this to your software. Okay, you are posting this to your software as the transactions are happening. Okay, then after on later, you now come and do the journals for the depreciation, for the depreciation element on it. So that is what I'm trying to show us so that we are not lost. Oh, sorry. Control C. We now come over here, Control V. Right. So that's what I'm trying to show so that we are not actually lost. So what else is happening? We now come to, yeah. So we have been able to do to 20. Yeah. Okay. So this is what you're going to do for this place. When you now come to 2011, right? We're also going to do the same. What you're going to do in 2011 now is going to be different. In 2011, the only thing that we purchased was actually the addition for the year. So in 2011, you're going to have something like this is just furnitures and fittings and office equipment, Abby. So let's come over here. Let's copy this thing that we have here. Let's just copy like this so that we have everything like this. So I copy, Control C, then I come over here. I come over here and I'm gonna keep this right here. Control V. Okay, so for this now, yeah. So for this now, you discover that here, what is happening? Addition during the year. Wait till I'm coming. Oh, why is this? Why is it copying like this? Okay, so I copied this and I brought it here. Right. So yeah, let me delete this. Yeah, so this is what I want to do. So you discover that here is only two assets that we actually purchase, not all the assets. It's only two assets that we purchased during the year. It's only two assets that we purchase. So what do we do? What are the assets? We purchase addition for the year. We purchase office equipment and functions and fittings. So we come to functions and fittings. We now say equal to. We're going to pick this. Yeah, we're picking this. Then our office equipment, we're also going to pick this equal to this. Office equipment, we're also going to pick this. Okay, we now say, yeah. So that is that. Then for this, give us the total that we are going to have. Yeah, so this gives us the total that we're going to have. Then for the accumulative, we're going to have for the year, charge for the year. We are charging this for the year. Yeah, so this is what we're charging for the year. This is what you're going to pick for the year. Then for the individual place, you're going to be picking For motor vehicle, you're going to pick these. Okay. For the other one, you're going to pick these. Yeah. For the other one, you're going to pick these. Then for the last one, you're actually going to pick this. You're going to pick these, okay? And that is how you're going to. So each of the years, there are different things that you're going to do. So this is what you're going to do as this thing is happening. Oh, yeah, yeah, yes, this is correct. This is the right treatment, okay? So this is what you're going to do for this year 2012, 2011. You come to year 2012, you do the same thing. Only treat for the asset section, only treat the addition for the year. While for the accumulated depreciation, treat what we are charging for the year. The total goes to the depreciation account in the profit and loss account, while the individual amount that make up this total goes to the what's it called? Goes to the someone should remind me. Goes to the individual asset accumulated depreciation account. Do we have any question? Any question? Do you have any question? Hello? Okay, so it's actually not as easy as it seems. The way you will know that it's not easy is when you have this kind of raw data, right? You have this kind of raw data, and then you are expected to, this is just the list of all the assets, right? You're expected to get the depreciation element, you're expected to post and all that. So this is what I'll be doing for the company on Monday. I'm going to be sitting with all this with them, showing them what needs to be done. I just felt that I should also show you in case you find yourself in that position in the future where you need to actually assist or to show people what needs to be done. Okay. So I just say I should briefly show you this so that you actually understand that at times it's important to know to note all these things because it's going to come a long way to assist you in the future. So that is how to actually do the possession. So it may look very easy, but it's when you're not doing it actually that you actually know whether it's easy or not. So some assets will be disposed of. We will finish the depreciation in the next 10 years. So this is 2010, 1, 2, 3. So that means that in 2020, year 2020, some assets should actually be gone. Okay. But they just continue to accumulate them, accumulate them. Like that, like that. So that is how it is. That's how it is. Some assets were disposed and all that. So, but don't forget that we are treating them one after the other by using our fixed asset register by year is what we are actually using. When we finish 1 year, we go straight to the other year. So little by little, we are accumulating. So 2013, in the year 2013, there was no purchase at all. So the year 2013, no purchase at all. We only have the opening balance, right? There was no addition for the year, which means that you will not record anything at the beginning of the year. Then at the what's it called? Closing balance, we have this, right? So for our closing balance now, yeah, they're only picking charge for the year. Now, the reason they are picking this is because, let me see, charge for the year. Why are they picking this? Let's check for something. I'm coming over. Uh, okay, so this is yeah. So that year it look as though things did not, because how can you have kind amount like as this? It's not looking okay. So, but I'm just showing in that 2013, something looks odd in the way it is. There is nothing here. Balance brought forward. Okay. Nothing is here. So let's also check what they charge. Over here also, they didn't charge anything for 2013. They didn't charge anything for 2013. Okay. So probably just to show a little something. That's what to just to show something to post for the year. That's why they put all these things, but they didn't charge anything for the year. But opening balance can also not be this. That means that something fundamentally went wrong that period that made them to be showing all these things. But let's leave that. Let's come to 2014. Okay. So the same thing is happening in 2014. And I don't know what could be the issue. Probably those assets were disposal, okay, during the year. Okay. So anyway, at least you've been able to see how it is being done, right? You've been able to see, oh, I get now. I see, I see. So let's come back to this 2014 or so, or 2013. Yeah. Okay, so I think in 2013, they started keeping three zeros up because the figures became so long. So they started keeping three zeros up. So here now they're not saying these things now they are in thousands. So they started keeping three zeros up. Instead of them to say this is 74,000, they now kept three zeros up. So let's see our opening balance. Our opening balance here should be our closing balance for the last time. So let's check here. Closing balance here. Okay, something is still wrong. Closing balance. Something is still wrong. But yeah, so that just it. Something is wrong. Let's just leave it at that. But I already show you the flow of information, the way information actually needs to be to flow. I've already shown us how information needs to flow. Okay. Now that is that. Do we have any question? Yeah. So somebody's asking if he or she is going to get the recorded class. Yes, you're going to get the recorded class. So that is how it's going to be. And that is how they did all this thing. So in order for you to understand that what they actually did is correct, you come to this 2020, you discover that this 2020, you have your closing balance as of that date. This closing balance will come as opening balance in 2021. It will come as opening balance in 2021. And this 2020, this opening balance, I think, yeah, because this opening balance now, we are talking about computer and this opening balance. So this closing balance, right? This computer, when it came to 2021, the the opening balance fizzled out. Oh, sorry, it's office building. Oh, office building now came up. Office building is a new asset that they purchased in this 2021. So that's why office building they just added that one. Okay, yeah, I get it, I get it. So they just put it in between these. Then they continue. Opening balance came, closing balance became our opening balance. We now look at the charge for the year. The charge for the year was what they actually put over here for each of the assets. The charge for a new office building was purchased, and this office building is also uh 10 is also going to be depreciated by 10%. It's only motor vehicle that is always be depreciated by 20%. So what do? You now get your closing balance. Your closing balance is going to be your opening balance plus your addition for the year minus your disposal, right? You're going to get your closing balance. Okay. So closing balance is going to be, like, yeah. So this one now, your disposal now is going to be a negative figure. So it means that if your opening balance is positive, your addition for the year is also positive, your disposal is going to be negative. Okay. So that when you add these things together, it's going to net off the disposal amount and it's going to only show you the asset that has not been disposed. Also, the same thing will happen for your accumulated depreciation. You're going to have your opening balance, which was closing balance for last year. closing balance for last year, right? Yeah, which was closing balance for last year. You're going to have it as opening balance. Then the next thing you want to do is when you have that as opening balance, you want to get the charge for the year. Remember, our charge for the year is always going to be 20% of what we have here. Okay, 20% of the total that we have here is what we're going to charge for the year, right? After taking away the portion that has been depreciated, sorry, the portion that has been disposed. After taking away the portion that has been disposed, we now say, okay, this our what's it called? This our charge for the year is going to be 20% of the balance brought down. Sorry, the 20% of the closing balance as at this date. That's what we're going to have our charge for the year and all that. So here, this one, the total now goes to our profit and loss account. The total for the charge for the year goes to our, sorry, yeah, profit and loss account under depreciation. Then all these now comes to the individual asset account as accumulated depreciation. Okay. At the end of the day, you're going to have your closing balance for your accum div, which is going to be the opening balance plus your depreciation for the year, right? Minus the disposal, you're going to get the balance, the accum depreciation at the end. So what do you not want to do now? You now say, okay, this accum div, we now say that what is my kind amount at the beginning? Your kind amount at the beginning is always going to be your opening balance for costs minus opening balance for depreciation. You're going to get kind amount at the beginning. Okay, then to get your kind amount at the end, you're going to say your closing balance for cost minus the closing balance for depreciation. You're going to get the kind amount at the end. Okay, and that is that. So I believe with this, we all understand depreciation. Anybody that doesn't understand depreciation should can consult me privately. I can still attend to the person. But one thing that is important, apart from you knowing the right thing to do, apart from you knowing what needs to be done, the next thing that you need to also do is that you also need to capture all these things in your account. The first capturing you need to do is, as at the time you are purchasing the asset, make sure you are posting it in your asset account. You are posting it in your account, okay, to show the asset that you have, and also to now show the portion that has been depreciated among the asset that you have. Okay, you're going to show them separately. This is going to be posted directly in your account. Why this one will be journalized? This is going to be journalized. So with that being said, let's now go to something else. Let's go and check for this our e-tax. This is going to work. So let's refresh the page and see whether it's going to work. I need to quickly run us through how to do our annual returns on e-tax portal. It's very important because we have like barely 3 days. No, we have 2 days left. Today is 28, 29, 30, 31. Yeah. So I think we have 3 days to go. Yeah, I think we have 3 days to go. So I needed to show us how to do our, so let me close this one and try again. Yeah, let me close this and let's try it once more. Okay, so we just come to, let me just search for e-tax. Let me just search for e-tax. Maybe that will be better, e-tax. Okay, so I can click on anyone. All right, so e-tax, the lrs.net, and then I select this one. Let's see if it's going to work. I know it's network. Network is what is actually, now a lot of people in Nigeria, in Lagos, for instance, a lot of people in Lagos will be trying to file. I did mine today at the office. I did mine today at the office and I was able to finalize it. Also, I was able to also reconfirm the address that I have because they have your details. If you already have an N tax number, so that your N tax number is what you're going to use to, hey, I think it's going now. So just like companies have a C dash their number, you also need to have your taxpayer ID. Hey, is that a taxpayer ID that we need for these annual returns? So let's see if it's going to open. If it doesn't open, then we now leave it tomorrow, which I pray that it will open tomorrow. But if it doesn't, I will also try it in the morning. Probably I will do a training on that, record it, and I will just share it to us on YouTube so that we can have it and then we can also use it to learn. So obviously, it's like this thing is not going to work. It's not going to work. A lot of people are on the portal. A lot of people are trying to do their annual returns. So the site is going to be very, very slow these few days. But you can also try it in the night, probably by 12 or by 1 or 2. You can also see try it. But with that being said, I will attend to it some other time. Are we together? Are we together? Can we call it a day for today? Any question? Mr. Ibrahim, do you have any question? Based on what we have done today.
No, I'll still go back to it. I joined late, but so no question till tomorrow. So I'll go back and check it.
Okay, no. Yeah, no problem. Who else is on the call? I wonder what is happening to people these days. People don't attend lectures any longer. So, Mr. Stanley, are you just joining us or you have been on the call for a while? Mr. Stanley, can you hear me? Okay, he has left. All right. So on that note, I think let's call it a day. Since this our ETALS portal is not opening, and I would have shown us how to file our annual returns. So what I'm going to do is I will target tomorrow, probably in the afternoon. I will try and do a recorded video so that I can upload it on YouTube for us to go and watch, and so that we can watch it on YouTube. But yeah, that is how that is going to be. So that we can watch it on YouTube. Right. So with that being said, I want to say let's have a lovely night. Thank you for joining the class. It's nice having you guys.
Okay, thank you, sir. Till tomorrow.
Okay, sir. Thank you.